Welcome to Knopman Notes, our series of online lectures covering the latest trends and rule changes as it relates to FINRA qualification examinations. This unit will cover communications with the public and new FINRA Rule 2210. I encourage you to use the navigation tools available to you to fast forward and rewind as necessary. My name is Brian Marks. I will be guiding you through this online program. If you have any questions about your examination or this rule or would like to discuss study strategy, please do not hesitate to contact me at any time. You have my office phone number, my cell phone, and my email address. As you prepare for your examination, keep in mind that not only is this rule changing, but there are other rules that are constantly in a state of flux. As such, it's important that you stay up to date on the latest changes because FINRA expects that you will know them on the day of your examination. The best way to do so is by subscribing to our YouTube channel and subscribing to our blog. For any rule changes, such as this one, those are detailed on our blog and on our YouTube channel. I encourage you to check those out prior to your examination. We would also very much appreciate if you would like us on Facebook, connect with us on LinkedIn, and follow us on Twitter. Let's begin with this rule, and specifically regarding communication with the public. We will start with filing and approval requirements for various categories of communication. FINRA Rule 2210 defines three separate types of communications. Okay. On this slide, we're going to talk about three separate types, and on the subsequent slides, we'll talk about the rules that apply to each. An institutional communication is any communication, either written or electronic, that is distributed only to institutional investors. Institutional investors include banks, insurance companies, investment companies, investment advisors, broker-dealers. Registered reps of broker-dealers are considered institutional customers or institutional investors, and any other person with at least $50 million in assets. So again, effectively a corporation, someone with $50 million in assets, or someone who works in the securities business, such as an investment advisor or a registered rep. A retail communication is any communication that is distributed to more than 25 retail investors within a 30-day period. And it's correspondence if it's distributed to 25 or fewer retail investors. So if it goes to more than 25 retail investors, it's a retail communication. If it goes to 25 or fewer retail investors, and again, that's in a 30-day period, it's considered correspondence. And what's the definition of a retail investor? Well, any investor that is not an institutional investor, as I defined at the beginning of this slide, is considered a retail investor. You can just think of this as an individual person with a securities account, but effectively anybody who's not an institutional investor is a retail investor. We're going to start with the rules regarding retail communications. And as you can imagine, because these are distributed to individual investors, retail communications are subject to more stringent oversight than institutional communications or correspondence. Specifically, retail communications must be approved by a principal of the firm either prior to first use or prior to FINRA filing. In a few minutes, we'll talk about when retail communications need to be filed with FINRA. So if it's a retail communication that's filed with FINRA, the principal has to approve it first. If it's not something that's going to be filed with FINRA, it still has to be approved prior to first use. If it happens to be a research report, so research report would fall under retail communication if it's distributed to retail investors. then it'll be approved by a supervisory analyst. And we'll talk about supervisory analysts towards the end of this section. There are some exceptions for retail communications whereby they do not need to be approved by a principal. The first exception is if another firm has previously filed that communication with FINRA and FINRA effectively approved, or they gave a no objection letter, which means that FINRA didn't have a problem with the substance of that communication. What are the circumstances under which a person at one firm would be using a communication filed with FINRA by a person at a totally different firm? I couldn't tell you. Unlikely to happen in practice. But if another firm had filed it with FINRA, then if it's used by a different firm, that would not need to be approved by a principal. Another exception is for research reports which do not discuss a particular security. These are sometimes called market letters. So this would be a report discussing broad-based indices, technical analysis, or particular sectors. Communications at an online interactive forum. So this would be a blog discussion, or possibly a posting or a conversation on Facebook or on an online bulletin board. Those are considered public appearances, and they are subject to different rules. Also exempt from the principal approval requirement are informational items not promoting a product. For example, a notification to a client that their account statement is available, or a notification to a client that one of the stocks that they own is expected to pay a dividend. Institutional communications, as I alluded to, are subject to a slightly lower level or less stringent level of oversight. Institutional communications require that the firm establish procedures for a principal to review those communications, not necessarily approve beforehand, just to review them. Okay. And if those procedures don't require approval, which is perfectly fine, a rep must be educated on the firm's policies so that the communication is prepared in accordance with the firm's supervisory procedures. Now, that being said, if a firm have reason to believe that an institutional communication might be forwarded to a retail investor, moving forward, that communication must be treated as a retail communication and must be approved. For example, let's say a broker prepares market commentary or some type of literature for a pension fund. The broker, though, learns that that pension fund has started distributing that literature to investors in the plan. Well, now the broker, any communication they prepare for that pension fund has to be treated as a retail communication. And it has to be approved by a principal before first use. So as a best practice here, FINRA encourages firms to identify an institutional communication with a legend indicating on the cover page that it's an institutional-only communication. That way, the firm or the investors can avoid accidentally forwarding that communication to a retail investor and subsequently trigger the pre-use approval requirement. Correspondence, as I mentioned earlier, is anything distributed to 25 or fewer retail clients in a 30-day period. So this would include an email sent to a customer or an instant message. However, if the same instant message is sent to more than 25, like for example, if the same instant message is sent to 1,000 clients, well, now it's a retail communication. So the distinction is 25 or fewer retail clients, it's correspondence. More than 25, it's a retail communication. Correspondence is really subject to the same rules as an institutional communication. So the firm must establish procedures for review by a principal but not necessarily approval before first use. That is not required for correspondence. Broker-dealers are required to maintain records of institutional and retail communications. You see the information that's required to be maintained. The firm must maintain a copy of the communication and the date of first and last use. It must include the name of the principal who approved the communication and the date of approval. If approval is not required for the reasons discussed previously, the record must include the name of whoever prepared the communication. The record must include the sources of any statistical data that is used. Okay. And if it is relying on that exemption from the principal approval requirement because it was already approved by FINRA, the firm must have the name of the firm that originally filed the communication and a copy of the FINRA review letter. So again, a rep can use a communication, a retail communication, without principal approval if that communication had been filed by FINRA with another firm. Well, then the record for that communication has to include the letter from FINRA effectively approving, or what's called the no objection letter, where FINRA didn't have a problem with the communication. I've alluded to a few times that in some cases communications will need to be filed with FINRA. So let's go into more detail about the circumstances under which communications are required to be filed. Okay. A new member, and a new member has been a FINRA member for less than 1 year. So a new member must pre-file with FINRA any retail communication used in public media, like an advertisement, so a publicly accessible website, a print media ad like a newspaper ad, or a TV commercial. That's public media. So newspaper, public internet, TV, radio. So it has to pre-file with FINRA. Pre-filing means it must be filed at least 10 days prior to first use. If that retail communication happens to be a free writing prospectus, which will be discussed in the investment banking unit, then it can actually be filed up to 10 days after first use. So post-filed, meaning rather than filing it at least 10 days before, it can be filed up to 10 days after. If a firm has violated a rule, FINRA can require that firm to file all communications, even if they've been around for more than a year. Or they can require them to file communications concerning certain products. If FINRA is going to require a firm to file all or certain communications, they have to be given at least 21 days notice before that filing obligation begins. So again, a firm that's been a FINRA member for less than a year or less, has to file all public media retail communications at least 10 days prior to first use, and FINRA can force other firms to file as well. There are some communications that are always required to be pre-filed with FINRA, no matter how long the broker-dealer's been around, no matter how long they've been a member, even if they've been a member more than a year. And pre-filing, again, means at least 10 days prior to first use. So any retail communications concerning investment companies with rankings that are not generally used or which the fund created. So, for example, if it's an advertisement concerning a retail communication concerning a mutual fund, and the ranking itself of where that mutual fund falls in the category was actually created by that fund, that would need to be pre-filed. Retail communications concerning securities futures have to be pre-filed, and retail communications including bond fund volatility rankings need to be pre-filed. And we're going to talk about all three of these things in more detail a little later. For now, all you need to know is that they have to be pre-filed, meaning at least 10 days prior to first use. There are other retail communications that are required to be post-filed, which means they must be filed with FINRA no later than 10 days after first use. And again, this is for all firms, not just new firms. So registered investment company communications that were not pre-filed. So on the previous slide, we talked about investment company communications with unusual rankings have to be pre-filed. Any other investment company communications that weren't pre-filed have to be post-filed. public DPP retail communications. We'll talk about direct participation programs a little later. Communications concerning CMOs, collateralized mortgage obligations, and we'll talk more about that a little later. Templates for written reports produced by an investment analysis tool, and we'll talk about investment analysis tools in a few minutes. And also any retail communications concerning structured or derivative products. So that would include options, for example, or what are called ETNs, exchange traded notes. There are some exceptions to these rules. So again, we've discussed the rules whereby new firms have to file communications with FINRA, and other certain communications have to be pre-filed, and other communications have to be post-filed. Well, here again, more exceptions. So if a retail communication was previously filed and isn't changed, you don't have to file it again. That makes sense. A retail communication with only statistical updates from a previously filed communication. So, for example, if the appearance of the communication is the same, you're just updating the numbers, it doesn't have to be refiled. Also, a retail communication that doesn't promote a particular product or service. So, for example, just a notification of the change in the firm's phone number, or a change in name or address, or even a notification that a broker-dealer is merging with another broker-dealer. Because that is not promoting a product or service of the firm, it does not need to be filed with FINRA. So again, even if it's a new member firm, they would not need to file that information. Additional exceptions include communications that identify a stock ticker or a list of securities in which the firm is a market maker, press releases, a list of the firm's products and services. A few more exceptions. New issue documents like prospectuses and red herrings don't have to be filed. Offering circulars. So basically documents used by issuers that are filed with the SEC. Okay. A reprint of a newspaper article does not need to be filed with FINRA. Again, even if it's a new firm, a reprint of a newspaper article doesn't have to be filed, as long as the publisher is not an affiliate of the firm, and as long as the firm didn't actually pay for the original article. So if it's a reprint of a newspaper article that's independent from the broker-dealer, it doesn't have to be filed. Correspondence and institutional communications do not need to be filed. So again, this really just applies to retail communications, and that's anything going to more than 25 retail investors in 30 days. Also, communications in an online interactive forum, such as an electronic bulletin board or a blog on a social media website. FINRA Rule 2210 specifies standards that firms must follow in the nature of their communications, and we will review those now. All communications by broker-dealers, and again, retail, institutional, or correspondence, require prominent disclosure of the firm's name. It's possible that that communication will also list the names of an affiliate of the firm, or it might even name specific individuals. If the communication includes the names of an affiliate or an individual, the communication must also disclose which services are offered by the firm and which services are offered by those affiliates or individuals that are named in the communication. There's one exception whereby communication does not need to include the firm's name, and that is for a blind recruiting advertisement. A blind recruiting advertisement, so an article that says so-and-so bank located in San Francisco is seeking to hire to fill this position with just a mailbox to send in a resume. That does not need to include the firm's name. Let's say a firm would like to discuss the tax consequences of an investment in a communication. If the firm would like to discuss an investment that is tax-free, it is required to define tax-free. Meaning, does that also include state and local taxes. Also, a broker-dealer cannot claim that an investment is tax-free if it's actually tax-deferred. So if you're actually going to be paying taxes at a later date, you can't call it tax-free. A broker-dealer might want to use a mathematical model illustrating the benefit of a tax-deferred investment versus a tax compounding investment. Tax-deferred is like a 401k where taxes are all paid at the end. Tax compounding is like a traditional brokerage account where taxes are paid every year. In order to use this model in a communication, the model and the illustrative example must include identical investment amounts and returns not to exceed 10% each year. Each account must use and identify actual tax rates. You have to make a disclosure that the transactions that accounts may be subject to state tax as well. You cannot assume an unreasonable period of tax deferral. So you can't assume that taxes are going to be deferred for 80 years. And the model must disclose that all investments, all disclosures from a tax-deferred vehicle are subject to ordinary income tax upon withdrawal. So you're never going to pay a capital gains tax when you take money out of the vehicle. You're always going to pay ordinary income tax when you take money out of a tax-deferred vehicle. The FINRA Rule 2210 series also has a number of rules that apply to communications regarding specific products. Investment company communications might seek to use a performance ranking like a Morningstar or a Fortune ranking. In order to do so, the ranking entity must be independent of the investment company, and the discussion of the ranking itself must be either their ranking or it must be based on their data. So the ranking used in the communication must be either the independent ranking entity's ranking, or it has to be based on their data. So for example, if you're talking about Morningstar as the ranking entity, it has to be either a Morningstar ranking or it must be based on Morningstar's data. If the communication is going to refer to the fact that the fund is the best performer in the category, that's only allowed if it's actually ranked number 1 in the category. It cannot refer to best performer as being top 5%. It actually has to be ranked first in the category. Investment company communications using a performance ranking must also disclose the name of the category that is being ranked, the number of funds in the category, the name of the ranking entity, we discussed that on the previous slide, the criteria on which the ranking is based, and the disclosure if there is any front-end load paid upon purchasing the shares. The time period of the ranking must be current to the most recent calendar quarter or to as recent as the last calculation, as long as it's not misleading. The ranking also must cover a time period of at least 1 year. And any rankings of entire investment company families, like all Fidelity funds, must also include the rankings for the individual funds by that same entity. Okay, so if you plan on discussing a ranking of Fidelity funds by Morningstar of the ranking of the entire Fidelity fund family, that communication must also include the Morningstar rankings for the individual Fidelity funds covered by Morningstar. A broker-dealer might seek to reference a bond fund volatility rating in a communication. Let's first describe and define what is a bond fund volatility rating. It's an independent third-party description of the sensitivity of the price of the fund to changes in market conditions. So again, it's a third-party description or calculation of the sensitivity of the price or the net asset value of the fund to market conditions. It's based on the credit quality, fund performance, expected prepayment, currency risk, interest rate risk. Investors in bond funds are required to receive a prospectus, because again, all mutual funds, as we'll talk about later, are sold with a prospectus. However, that being said, an investor can receive a communication with a bond fund volatility rating before they've received a prospectus, only if it makes certain disclosures. Again, so these are disclosures required if an investor is receiving one of these communications even before they've received a prospectus for that particular fund. Those disclosures are that the rating can't be described as a risk rating. The information and data must be current. The specific methodology of the rating must be offered via a toll-free number or on a specific website. All current bond fund volatility ratings must be included for that particular fund. And the rating must be described in narrative form. So what is 2 stars, 3 stars, 5 stars? What does that mean as far as sensitivity or what an investor could expect? So again, these are disclosures required if an investor is receiving one of these communications before they've received a prospectus for the particular fund. Some broker-dealers will distribute investment analysis tools to clients. An investment analysis tool is a tool producing simulations and statistical analyses that present the likelihood of various investment outcomes of a portfolio. In plain English, it's a college tuition calculator or a retirement plan calculator. The tool must be post-filed with FINRA unless it's made available only to institutional clients. So if it's only used by institutions, it doesn't have to be post-filed. But if it's used by retail clients, it's got to be post-filed. Also, any templates of reports produced by the tool also need to be post-filed. So not only the tool itself, but also the report that it produces has to be post-filed, meaning up to 10 days after first use. Disclosures required in the tool include the methodology and criteria, the universe of investments, and any bias in the selection universe. Any bias means if the firm only uses tools, securities in which it was an underwriter, or in which it's a market maker, or are its higher revenue producing securities. So if there's any bias in the selection universe, that is required to be disclosed in the tool. Broker-dealers might prepare communications regarding securities futures. These communications must be pre-filed with FINRA unless they were already filed with a futures regulator like the NFA. If they were pre-filed with a futures regulator, they don't need to be filed with FINRA. If a retail communication regarding securities futures is distributed to investors prior to distributing a risk disclosure document for that product, the nature of the communication is limited. It can only include a general description of securities futures, the contact information for providing and obtaining the disclosure document. You can't discuss particular products. You can include a description of futures and exchanges, and you can include special font, advertising, design, etc. The point is, if you're distributing a retail communication regarding securities futures, and that investor has not yet received a disclosure document for that product, you're limited to what you can say. With regard to restrictions for this, a firm can never suggest for securities futures that there is any certainty at all of a secondary market. They can never suggest the certainty of a secondary market. A broker-dealer might seek to use projections in a retail communication regarding securities futures. In order to do so, an investor receiving that communication must already have received a risk disclosure document. The projections must include commissions, fees, and interest. Projections have to be plausible, and assumptions must be clearly identified. If the firm would like to discuss the use of past recommendations, the performance of past recommendations in a retail communication, pretty much has to follow the same rules. Investors must have received a disclosure document. Commissions, fees, and interest must be included. It must be confined to a specific universe of recommendations over the previous 12 months, and it must include all of those recommendations over the last 12 months. The firm can't cherry pick only its recommendations that have outperformed. And it must include the data recommended to get into each investment and the data recommended to get out of each investment. So again, if you have retail communications regarding projections or performance of past recommendations, there's a higher level of items that must be included. If a firm would like to use worksheets discussing mathematically how securities futures work, they must be uniform, meaning a firm can only basically use one type of worksheet. So each rep can't just go and prepare their own mathematical worksheet. Each firm has to use their own type of worksheet. Because of inappropriate sales practices of CMOs that have occurred in the past number of years, there are rules that must be followed regarding communications for CMOs. A communication must use the specific term collateralized mortgage obligation. Can't be compared to any other investment vehicle. The tool must disclose that any government backing only applies to the principal. It does not apply to the market value, for example. Also, the communication must disclose that the yield and average life depends on interest rates and prepayment. Investors purchasing CMOs must be offered educational materials prior to sale. Those educational materials must include a discussion of the characteristics and risks of CMOs, a discussion of structure and what it means to have a tranche. It must discuss the relationship between mortgages and mortgage securities. It must detail questions an investor should ask, and it must include a glossary of key terms. If the retail communication discusses specific CMOs, that retail communication must include the coupon, the yield and average life, tranche information, and generic description of tranches, final maturity, underlying collateral, minimum denominations, ratings, any government backing, payment structure that's similar to tranches. Also, it must disclose prepayment assumptions. Prepayment assumptions. Prepayment assumptions also need to be disclosed. That concludes this installment of Knopman Notes. As always, if you have any questions, feel free to contact us. You have my contact information on the second slide. Feel free to repeat and rewind to review concepts. And as always, best of luck on your examination. Thank you.